Welcome to Geojit Spotlight. Since its lows in March, the market has experienced a tremendous rally. What are the main reasons behind the rally? Will the market set new records? Let's get answers from Geojit Chief Investment Strategist Dr.V.K Vijayakumar. Welcome, sir. So the market has rallied smartly from the low levels of March. Are we moving towards new record high? What are the prime movers of this rally?
Yes, the market is showing great resilience. The rally is strong. By end March 2023, the Nifty was around 17,000 levels. So this is a 1,400 point rally in the Nifty, more than 6% rally. So the rally is very strong. The market momentum is strong. So the main reason for this sharp rally and the strength in this rally is the massive foreign portfolio investment that has been happening since the second half of April. During the first 3 months of this year, January, February, and March, foreign portfolio investors have been relentless sellers in the market. Their strategy was sell India and buy China and other emerging markets like South Korea, Thailand. The reason was those markets were very cheap. But they are not so cheap now. Values have gone up. And starting from the second half of April, foreign portfolio investors have turned big buyers in India. During the last 13 trading days, I think starting from April 26th, FIIs have been continuous buyers in the market. Every day they have been buying since April 26th. The latest NSDL data up to May 15th shows that foreign portfolio investors have bought equity worth more than 24,000 crores in May alone. This is a sudden change in the FPI strategy. This has also led to some short covering, leading to sharp rise in some of the leading stocks.
So inflation is coming down. How will this impact interest rates and stock markets?
A major reason for this change in strategy of foreign portfolio investors, also DIIs also have been buyers, but they have been also sellers on certain days. The major reason is a sharp positive swing, a change for the better in India's macro fundamentals. I would specifically mention the decline in inflation in India. The April CPI inflation has come at 4.7%, the lowest in the last 18 months. This is very much within RBI's comfort zone. Maximum is 6%. So 4.7% inflation is a low inflation. Not low inflation, but within control. And the WPI inflation, which came yesterday, May 15th, shows that WPI inflation has gone into negative territory for the first time in several months, more than 20 months, I think. So this means RBI, the implication of this decline in inflation is that RBI is likely to pause in the next Monetary Policy Committee meeting also. In the last Monetary Policy Committee meeting, they decided to pause, contrary to the expectations of a 25 basis points. That was a consensus view at that point of time, but they paused and they were right. And now with the declining inflation, it is quite possible that RBI may pause again on June 8th when the next monetary policy decision will be announced. So this means the market already has started discounting that, and you look at the 10-year bond yield. 10-year bond yield has dipped below 7%. So the market is signaling lower interest rates in the coming months. Also, if inflation remains at this low level for a few months more, it is quite possible that the RBI can cut interest rates toward the end of 2023. So this is a very good signal for particularly rate-sensitive sectors in the market. Rate-sensitive sectors are those sectors which are sensitive to interest rates. So when the interest rates decline, they will boom. For instance, the real estate sector. Secondly, banking we know is rate sensitive. And thirdly, automobiles. Bulk of the automobile demand comes from the vehicle loans, people who buy using vehicle loans, particularly fleet buyers. 80% of demand for commercial vehicles comes through bank credit, more than 80%. So that these segments are rate sensitive sectors, and they have improving prospects if this situation of declining interest rates continues. I've been observing the performance of real estate companies during the last few days. They have reporting good numbers, not results, good numbers in home deliveries. So home deliveries are improving. Record home deliveries are happening, particularly in the luxury segment. So that means the real estate segment will do well. For playing the real estate segment, you can buy the real estate stocks directly like DLF, RBI, Shobha, etc. Or you can approach indirectly by buying stocks in paints, adhesives, electricals, and ceramic tiles, ceramic hardwares, and those segments. So these are some segments which will benefit from a possible decline in interest rates. Banking will continue to do well. The results have been very good. With this low interest rates scenario continuing, without RBI raising interest rates for many months together, and the possibility of a rate cut towards the end of 2023, banking will continue to do well because credit growth is impressive. And automobile demand results have been good for automobile companies. Automobiles also will do well. So these are the segments which will gain from this sudden dip in inflation and the consequent, what the market is expecting, the consequent pause in interest rates by the central bank, and a possible rate cut towards the end of this year, calendar year.
Thank you, sir. Thank you very much.
Thank you.